The fade in S&P futures aftermarket is kind of interesting given another soft close on the day. But yesterday's pop was real big and the NASDAQ put in all-time highs. Russell looking pretty weak. Small caps kind of a story on their own as we are now eating back into that post-election rally. But my most interesting observation, I think, today is bonds. I think that's where we can kind of glean the most, so that's what I want to look at on the charts. I've had the yellow light on bonds and the dollar. Looking like that might have to flip around a little bit because the selling pressure is getting pretty real in treasuries again, and the resilience of the greenback is turning into strength once more. So this is a pretty interesting situation we've got here. You can trace the lows in the yield back to Friday's employment, which is pretty interesting. Look at the charts, and you see, I think, one, the dollar's already told us that yields are probably more likely to go up than down. But here's where the dollar's at now, 107. This is real close to our high from November. So the dollar is like now found support and looks like it's turning around. If the dollar gets back through 107.5, light's going to go green on the greenback because, as I've stated many times, it's just very hard to see the bear case in the dollar. There's definitely some irony into this because of the expectations for a Trump 2.0 presidency to be lower dollar in theme. But that's mostly been an economic talking point that's come from largely the crypto crowd, and I don't really trust them on the economics, and neither should you. When they talk about low dollar, they're thinking about a trade-off that just has never really been there. Bitcoin's done well when the dollar is strong, too. So the logic that there needs to be a lower dollar for these economic events to unfold that are pro-growth and all these things, it just doesn't make sense. The dollar's been strong because we're the best house in the block by a mile. Everybody else is eager to cut and racing to cut to the bottom. And that's not a good situation for Europe. It's not a good situation for Canada relative to us. So the dollar's just not going to break down. This is not something to really worry about. And it's not something you want to design policy around to get the dollar weaker. The dollar's been associated with good things. Also, we want spending power. You want buying power. We are not an exporting country. We want to be an importing country. That's where power is. So, looking for any reason to turn the dollar green, basically. Then look at bonds. That one's a little bit trickier. But because there still is the downside for yields argumentatively that I think is more compelling than the downside for the dollar. But if you just focus on the potential upside for yields, which basically consists of one major point, which is that yields found their bottom in September when the Fed started cutting. And if the Fed's going to cut again in a week and take another 25 basis points, that's loosening and that's financially stimulative to the economy. So it makes sense then that we should start to reprice for growth. And I kind of think that's what we've been doing again. The inflation numbers weren't too concerning this week, even with PPI and those hot eggs. The 10-year yield actually traces back to the recent low of 4.1 to last Friday. That's the employment report, which was a solid report. So again, you've got a chart that aligns more with economic events. And since then, we've continued to fade bonds, pushing yields higher. Once again today, they tried to rally bonds early, faded back around. Yesterday, tried to rally bonds early, faded around. We had auctions that were pretty strong on the long end of the curve, and we faded anyway. So the conviction for yields is pretty much back here. Last chart is the curve. Look at the 10s to the 2s real fast because there's a message here that's also positive in nature, which is that steepening that's happening again. Here's the steepening that's going on. This was the curve flattener we were getting when folks were thinking maybe the Fed wouldn't be able to cut in December. The Fed's likely to go. Next year is going to be a very tough case for them to continue cutting, though, based on some of these messages here, which suggest economic resilience, potential for growth, a strong jobs market, reasons for yields to drift higher again, maybe get the red light back on for bond prices if we break fresh high yields relative to earlier post-election. Have a great night.